Welcome to the latest Pension Corporation debate on the importance of being gilt-edged. My name is Jonathan Stapleton, Editor of Professional Pensions. With me, joining me for the debate are David Collinson, Co-Head of Business Origination at Pension Corporation, Rob Gardner, Co-Chief Executive at Reddington, Mark Gull, Co-Head of ALM at Pension Corporation, and last but not least, Matthew Denwell, Partner in the Financial Strategy Group at Mercer. Welcome. Matthew, if I can start with you, why are gilts relevant at all to funding?
Well, as regards measuring the liabilities, pensions are a series of cash payments, sometimes inflation-linked, and if you regard pensions as deferred pay, then they should have the same credit quality, the same probability of being paid, as the salary that employees have already received. Well, gilts are the traded investment that most closely reflects that kind of stream of payments in terms of its payment profile and credit quality. So the gilt yield curve is a natural place to go to measure pension liabilities.
David, do you agree?
Yeah, I can see why gilts are relevant to calculating liabilities. Effectively, at the end of the day, you're saying, what amount of gilts would I theoretically need to hold to meet all these payments that are going on into the future? However, I'd say that it's the insurance buyout price of the liabilities is much more relevant as a measure of the true liability, because at the end of the day, that's the price that you have to pay to ask someone else to take over your liabilities. So it's, if you like, the market price of the liability, which takes in factors that aren't necessarily fully involved in the gilt curve. So yes, gilts are relevant, but I think the insurance price is more relevant.
Rob, do you agree with all of that? Is it really relevant?
Well, you do need a benchmark discount rate, and so I'd agree with Matthew that a gilt rate is a good place to start. It's the deepest, most liquid, observable market to extrapolate that. I'm actually a big fan of the interest rate swap curve and the inflation swap curve. Arguably, it's maybe a little bit more granular than gilts. David, just on your point, though, about the buyout, wouldn't it be fair to say that some of the other assumptions that aren't captured in the gilt market can be expressed as a spread either to gilts or to swaps?
Yes, they could, but it's the process of actually reflecting those, I think, in the value. You start off with your gilt rate, you then can have a spread to allow for deflation risk, to allow for longevity risk, etc. So, I think but at the end of the day, you end up with a single figure, which is your cost of asking someone else to take over that liability.
Do you have a view at all?
I think probably sort of less strongly held than some of these other guys, but I do think, one of the interesting points raised is people talking about the gilts being the biggest, most liquid market out there, and there's an assumption in there that it's providing some economic information. And I think one of the debates is, should we be talking about where people can make returns for what their investments should be? And the gilt market is now quite a distorted market with QE. And I think there are some issues that we should come on and discuss about that in due course.
I think distorted market might be actually one to throw back to you, Rob. I mean, currently we've got a range of things influencing the prices. The gilt yields at the moment, QE is coming in, and what are we up to now? £375 billion. We have a whole host of insurers who have to hold gilts for reasons entirely separate to pensions. Do you think that the very fact that we have these huge distortions in the marketplace means that gilts are no longer sort of sustainable as this sort of benchmark?
Well, for full disclosure, I'm a mark-to-market purist, so I think it's important for me to set out my stall so there's no sort of lack of understanding from where I'm coming from. So I like the idea of a transparent benchmark to value a set of cash flows the way Matthew described. I think if you separate the sort of valuation of cash flows from whether the price for that is good or bad value, then that's an important thing to discuss. I think the second thing, and it actually comes back from David's comment about actually a buyout being a better valuation than gilts, is that whenever you're valuing something, you have the ability to apply an adjustment So one way would be to go more prudent to a buyout, but many corporates, when they recognise this pensions risk on their balance sheet, actually use a corporate bond rate, which is arguably a spread above gilts. So I like the idea of a gilt rate or a swap rate, and then actually applying a spread above it or below it to adjust. At least there's a level of transparency to compare and contrast pensions risk across different pension funds.
Matthew, do you have sort of any? Are you a mark-to-market man? Do you sort of sign up? Or
Very much so. But I think you have to mark to a tradable market, to a deep and tradable market. That's probably where I would take issue slightly with David's focus on insurance buyout rates. I think the problem there is you don't know what the buyout cost is until you try to do a transaction. Otherwise, you're estimating. We make good guesses, but that's all it is. And secondly, that market is affected by issues like capacity, commercial pricing and competition. So it's not a traded market. That would be the objection that I would have to using buyout rates.
But the AA corporate sort of bond yields, sort of very thin markets there. Do you think that's a hindrance?
Well, if you're talking about how we measure pension liabilities, if that's what we're talking about, then what level of credit risk is right to include? And I would argue that, as I said, if pensions are deferred pay, they should have a very high credit quality indeed. Now, just to pick up on Rob's point, I think if we get to a point where where swaps are yielding in excess of gilts again, and you price allowing for the cost of collateral, a well collateralised swap starts to approach, I think, a gilt yield and could be an alternative means of measuring pension liabilities. But for where the markets are relatively at the moment, I think you've got to start looking at gilts as your benchmark.
If we accept gilts are going to be the benchmark, where are we going with this? I mean, we have current sort of record lows in gilt yields or near record lows. Is this sort of, are these lows a long run, short run thing? You know, where are we heading with for the future? Are we going to see mean reversion?
Well, you know, on the one hand, you can say, looking historically at where gilt yields are today compared to the past, at some point they're going to go up. But that's not a high-risk statement to make. The key question is when. Now, many people think, certainly in the next few years they're going to go back up from where they are today. But if you look to places like Japan, the equivalent yields have been low for 15 years. And I think if you go back to the US in the 1930s, US 10-year Treasury rates were below 3% for 23 years between 1933 and 1956. So, you know, we could be in that sort of situation. Low yields could be with us for an awful long time.
Rob?
Yeah, I mean, look, 1998, the 30-year gilt rate was about 6.2. Today it's about 3.1. The 30-year index-linked gilt rate was about 3.1% in 1998. Today it's 25, 30 basis points. And I've followed David's argument. I'm not a subscriber to the mean reversion camp because actually I think there's an explanation for why rates can remain where they are, and I think there's an argument for why rates could go lower, as in the Japan situation. So people describe us being in a Japan situation, but actually relatively we're not. There's still another leg down. Not for this discussion, but I would encourage viewers to download a paper written by Reinhard and Roghoff on financial repression. But really it's the idea that you let inflation run higher than your nominal rates. And so if you're a government and you're trying to solve the liability problem of the debt problem, a sensible strategy is keep nominal rates lower than GDP growth. And so if we have low GDP, you have to keep nominal rates lower than that. And you let inflation run a bit higher. And that allows you to erode away your debt. That story is a very explainable and rational way out, not just for the UK, but for a whole load of countries around the world right now. And I certainly believe that that is a sensible way out for governments to act. It may not be in the best interests of DB pension funds, but I certainly think it's a very plausible central case. And therefore, I think nominal rates and real rates could stay where they are for a long period of time. And I'll just end on this point that is often missed, is that if I took the gilt yield curve today and we rolled forward 1 year and we had the same shape of the gilt yield curve, the present value of your liabilities will have gone up by about 3%. And most pension funds aren't really aware of what's called the roll down of their liabilities. So actually there's an argument to hold gilts just to stand still. And maybe we can come back and discuss, is there merit in holding index-linked gilts at 0%?
You certainly will. Matthew, what's your view on this? Do you believe there'll be mean reversion? I mean, we seem to have a bit of a difference of opinion here between mean reversion and non-mean reversion. Are we, any time in the foreseeable future, going to go back to?
Yeah, well, I do think everything does come round. Eventually, number 27 will come up on a roulette wheel, but I don't regard that as being very helpful in planning a wealth creation strategy. So I think there's I'd agree with many of the comments that have been said. There's every chance that there will be reversion at some time, but we don't know how much and we don't know when. And there's a chance that rates could stay very low and could stay very low for a long time and could possibly go even lower. Some of Rob's arguments I'm not quite convinced about, because what that actually means for a country's ability to trade internationally, I think there are some adverse implications there. So how long that sort of continual inflation could go on for without it causing severe problems, I'm not convinced about. But I think the fact is we really don't know. So the important thing is whether or not you believe that there's going to be reversion, you've got to have a plan B. So you've got to have a plan that says, OK, we might think that there will be reversion, and that's our plan A. We have to have a plan B if that doesn't arise.
I mean, it's clear, no matter whether gilt yields are going to revert or whether they're not, that right now many sponsoring companies are suffering from huge deficits in their pension schemes and struggling to make up the shortfalls. Do we need to consider discount rate smoothing and perhaps allowing a little bit of extra help to sort of help make up this gap between maybe some sort of mean reversion in 10 years, some long-term averaging? Do you have a view on that, Mark?
I certainly do. I think it makes an awful lot of sense. I think one of the things that the government should be pushing for and has been talking about is its growth agenda. What we're getting at the moment by by pension funds deficits being pushed up is money coming out of corporate sponsors, which could be actively used to invest in those companies, more jobs, more growth, going into the pension funds. And a lot of that money, I mean, the NAPF ran a survey last year on that, and because of low yields, slightly more money is going into adding into more gilts than taking higher risk on that. So it's not being used productively. And I think there is a misallocation of capital. And the potential providers of long-dated capital, the pension funds, the insurance companies, should be using that more productively than just investing in gilts. Now, I very much take Rob's point on view and agree with that. It helps the government in terms of it working its financial repression at the moment, that it helps for a while managing the deficit down. But I think for a long-term solution and to get growth through to the economy, we should be looking at ways that actually encourage pension funds to invest for the long term. Marking them off gilts, particularly where it's an officially distorted market, isn't the way to do that.
So I don't follow the argument or buy the argument that smoothing A forces you to buy gilts and B stops you from investing for the long term. So I like your thesis about investing for the long term and encouraging pension funds to do the right thing. I don't think having a gilt-based benchmark A forces you to buy gilts and B stops you from going down that route.
I agree it's not absolutely forcing you, but it depends on the ability of the sponsor and of the scheme to take risk, because your pension fund liabilities are marked on a regular basis, and if you have to put more money in, if you can't take any more volatility, you have to shut down that risk, and you don't want to get to a situation whereby companies go bust, and we've seen that with Dawson International, for instance, because it's having to tip money into its pension scheme, where otherwise it has a valid business. Smith Industry has said, it's money it could have used productively to invest in the company has had to go into the pension scheme. I think we need to try and get that balance right, and I think the smoothing would help that.
But two wrongs don't make a right, and I think this smoothing argument is a bit of a red herring. If you're going to smooth yields over a period when they've been higher and lower, then you need consistency in both sides of the balance sheet, how you value your assets and your liabilities. So you're then going to have to value assets over a period when they've been lower and higher. And you don't necessarily end up in any better place if you smooth assets and liabilities consistently. I'm not convinced that this argument that for smoothing is really a deeply rational and principled argument, or whether it will fade away once we get to a position where the smoothed answer looks worse than the unsmoothed answer.
I mean, I think there's a very clear issue that the gilt market, what we're using as the basis to measure liabilities, is now an officially distorted market. QE's happened, as we've said, there's been £375 billion of gilts bought by the Bank of England with the aim of changing the yield in that market.
Well, the market's what it is. The market's what it is.
But it has economic consequences. Do you think we should...
Do you smooth down equity markets? So there's research by people like Andrew Clare from Cass University that shows that actually the equity market, let's say the FTSE, is probably 500 to 1,000 points higher as a result of QE. Would you also advocate smoothing the equities? Because I follow Matthew's point. You need to smooth both sides of the balance sheet to be consistent.
We're not using the equity market to measure the liabilities. But what you're doing is you're forcing money to come out of productive areas in companies into pension schemes where they're being less productive because they're investing in more gilts. I think what we're missing a trick in terms of managing the overall economy most efficiently. And it's an argument about managing the economy more than managing the risks of pension funds. I accept it adds higher risk to pension funds.
What about the argument that actually if we'd been benchmarking properly all along, we wouldn't have got into this mess? So actually, arguably, a number of these pension schemes could have locked down the risk, were in surplus.
Yes,
even 5-6 years ago.
And that, as an insurance company, that's exactly what we've done. That's exactly what we've done. But if we want to get the growth back on the agenda, we need to get productive capital invested for the long term. There is a pool of capital there that is not being utilised in the most effective way because of the way the system works at the moment.
And I think it's one point actually to bring up here. This is not sort of cloud pie in the sky sort of thinking. I mean, we've had the US have done some sort of discount rate smoothing. We've had several European countries now who have altered the discount rates being used by pension schemes for liability discounting. And we have bodies such as the NAPF calling for it, the CBI have called for it, and we've got notable bodies such as the pensions regulator who are insistent we don't use it. David, you have a view. Are you?
Yeah, I mean, if the aim is to provide relief to sponsors, so that maybe they don't have to fully fund the deficit, or have some relief on the extra deficit that's been caused in the last few years as a result of gilt yields coming down. If that's the aim, let's be explicit about it. Let's not try and hide it with discount rates moving. Let's meet the objective, which is to keep money invested in businesses, to have pension funds investing effectively, just like Mark said, but let's not do it by the back door by hiding it in some discount rate smoothing. Let's do it very explicitly.
And you could do that. You could separate out what is, if you had a normal or sensible rate that you thought was fair, and you could work out the contributions on that, and you could have a QE adjusted contribution, and that could maybe be back-ended, and that would solve that problem, and it would be a lot more explicit way of solving the problem. I think your second point about the growth agenda, I think that's a non-point. I think the deployment of assets is the deployment of assets, and pension funds can still be encouraged to invest in infrastructure or any of these other assets and get the growth agenda back on. And I think David's point is a much more eloquent way of solving the pension. Companies maybe putting too much money in right now, today, to fund their pension scheme.
So this would take a specific action by the pensions regulator to say, well, under your current accounting, your deficit is £1 billion. The adjusted deficit that we will use for your contributions is £500 million, and we'll take a contributions plan based on that £500 million figure. But your deficit is still £1 billion today.
Something along those lines. I think you'd have to have an A and a B contribution mapped out, and maybe the back end. I mean, I don't like it at all, but if I don't agree that smoothing is the way forward. To me, smoothing is like the argument that Lance Armstrong says, "Okay, I took drugs because everyone else took drugs." That to me is not an excuse. I think we've all argued that you need a benchmark for valuing it, one that's transparent, one that's liquid. Why would you take something and smooth it up and take away all of those characteristics away from it?
The A and B are already in place. The regulator already accepts that pension funds may use a gilt-related, shall we say, discount rate for their technical provisions, but allow for some additional investment outperformance in the recovery plan. And the key thing, again, is to have a backup plan if those anticipated outperformance returns do not materialise. And there's the rub, because actually, if they don't materialise, maybe many UK businesses are looking that they can't afford their pension funds, and we have to get realistic that many pension schemes actually may be unaffordable for the businesses that support them. That's even before we get Solvency II labelled on, added on top of that commitment.
Let me just take this debate in a separate direction a little bit. We've been talking about discount rates, how gilts influence those discount rates. Should gilts even be used as an asset class? Should schemes be looking elsewhere, looking at things like social housing, ground rents, infrastructure and so on? Could you say it was complete and utter madness to be investing in gilts at this time? And if you sold them and decided not to invest in them, what would you be looking to buy? Rob, can I start with you?
Well, yeah, I'm going to be somewhat controversial. I actually would like to encourage pension funds. A, we're trying to get pension funds to think about assets and liabilities. I think B, we should get them to think about return and risk. And what that does is it allows you to talk about asset allocation to a risk-based framework. So when I think about gilts, I think they have nominal risk, they have inflation risk, and they have some kind of credit risk. And so when I think of a gilt, I'm thinking about what those three properties are. So we have pension funds, and I'm pretty sure Pensions Corp might actually hold a gilt not because of its interest rate view, but because of its credit view called the swap spread. So when you start to think in a risk-based world, then gilts have a utility function. I think the point that Matthew was talking about having a plan B is one that resonates completely with me and the clients we advise, is that you've got to have a risk-based framework which says if our assumptions of mean reversion or assumptions don't come out, what do we need to do to take that risk off the table? The other point is that actually by using liability-driven techniques and overlay techniques, you can actually, with £100 million, own some gilts and own some equities, and you can technically turn £100 million of capital into some gilt exposure and some equity exposure, which on an asset perspective seems a bit risky, but actually from an asset liability perspective isn't. And maybe we should sort of debate that point and then separately come back and discuss the non-gilt assets like social housing and infrastructure.
David, do you have a thought on that?
Well, again, the other sort of factor in gilts that I think Rob didn't mention was liquidity. You know, as an asset class, there are very few things that are as liquid as gilt. So, you know, and that's where their other uses, such as being part of a hedging approach that you are effectively forced into holding gilts and cash because you need those for collateral. You know, there's that aspect to gilts as well. You know, I would say this, wouldn't I? But you know, at the moment, to me, an insurance policy looks better value than a gilt because it's a perfect match to the liabilities. It has longevity cover in it, and it's priced consistently at the moment. Insurance policy isn't liquid, though. A gilt is.
Yeah. Matthew, do you see this sort of? Do you think we're measuring, you know, looking at assets in the wrong way? Do you think that perhaps we should be looking at a different way of risks and returns?
Well, I think that there's a continuum. It might be a bit of a bumpy continuum if that analogy isn't too complicated. But you know, at one end of the scale, to the extent that gilts are a natural hedge for pension fund liabilities, you know, that's a natural place to start. So the question is, how far do we move away from that? As I've already mentioned, I think swaps with collateral get pretty close and maybe a very near substitute. Once you get into corporate bonds, the amount of credit is going up, so you're moving further away from gilts. Infrastructure, social housing, well, you know, these are not gilts and they're not bonds, they're something else. Now you can wrap up equities, infrastructure, housing, property. You can wrap these things up into structured products that may have some bond-like properties, but you're moving away from gilts. And you know, somewhere along this continuum, do you remember we had that asset class called AAA-rated subprime mortgage bonds? So we just have to be careful that if we go into alternative things which are not very low risk investments, because we think that they might actually provide us a better alternative to what really is a low risk investment, we have to understand what really is underneath, you know, what's underneath that white label.
Yeah. Well, I take that point. I think it's absolutely vital that, you know, that any pension scheme, any investor understands what they're investing in. However, I would say for a lot of pension funds, where they're looking to get some extra yield and they need some extra yield to help close some of those deficits, to invest in reasonably low risk assets that provide a return above gilts. And you mentioned things like social housing, where you can get long dated bond-like structures that do match the liabilities and give you an extra spread, and in a lot of cases are secured. So if something goes wrong with a housing association, you get the properties as well. Those are pretty safe investments. Yes, they're not gilts, but the compromise of giving you an extra return, I think, is a very sensible place for pension funds to go.
What kind of return is that right now, Mark?
You get 150, 200 basis points over the gilt yield. So if you've got a 30-year gilt yielding roughly 3%, you get 4.5%, maybe in some cases 5% for these things. And so it is an extra benefit. We can't. And the other point about the gilt market is a finite size. The size of liabilities, the defined benefit pension scheme is what, about £1.4 trillion. The gilt market isn't that big. You know, it can't all go into there. You know, you have a more distorted market. So we want other areas for this money to go in. And I think those types of structures that are coming out, and particularly as the banks are stepping away from long-dated funding, are a great place for pension funds to go, because they do the two things they really want. They help match the liabilities and they manage the risk, the point that Rob's make, and they give them an incremental return. But taking Matthew's point, you need to understand the risk in them.
And that's why I like to look in a risk-based framework rather than an asset class. So actually, David was right, I did miss out liquidity. So if I say a gilt has nominal risk, inflation risk if it's an index-linked gilt, credit risk and liquidity risk, I can then look at a social housing bond and say, well, it's paying me 150 or 200. I can compare and contrast the rate risk of a 10 million or 100 million pound bond. I can compare and contrast the inflation risk. I can compare and contrast the credit risk. No, they're not the same. I can compare and contrast the liquidity risk. No, they're not the same. But then ask myself as an investor, an informed decision, is 150 to 200 basis points the right amount for taking that risk? In fact, you can follow that argument for a whole load of asset classes and start to make that trade-off. And actually, when you start to think in a risk factor framework, it is a lot easier to compare and contrast these assumptions, because you do need return. Whether you use smoothing or not, I think the point that Matthew and I were making is we probably want to take a more market-consistent approach on the liabilities, which then does mean you have to earn an extra return on the assets. I certainly believe that some of these assets might be a better risk-adjusted way of meeting the liability risk of rates and inflation and earning that excess return, but it's open for debate.
I think we have to have our eyes open very much when we assess risks and look for correlations. And you know, we've been there in the very recent past. You know, the kind of circumstances in which the rents might not be coming through on these properties might be exactly the same circumstances in which the property values themselves would be depressed. Other people wouldn't have an interest in buying them, and exactly the very same circumstances in which case local authorities couldn't come to the rescue because their council taxpayers weren't prepared to see an increase in their expenditure as well. So we just have to watch out that we aren't repeating some of the mistakes from the past when we look at alternatives to ready-made, low-risk assets, and we try to convince ourselves that something else actually, you know, is the same.
But Matthew, the debate isn't that you should be going from gilts to that. Is that your gilts doesn't. Let's say you need gilts plus 3. Well, how are you going to get your +3? So the alternative is to hold equities. So you've got to compare and contrast holding a portfolio of equities and a portfolio of gilts.
Absolutely. I think the danger is where sometimes I feel as if some of these asset classes are held out as being an alternative to gilts and bonds. They're just another way of getting beta.
There's a huge range of alternatives there, and you said there is a spectrum of risk, and what you need to do, as I said again, is completely understand those risks, and that's what good credit analysts about, good fund management is about. You know, your risk-return trade. Are you being rewarded for the right amount of risk you're taking? And I think you have to do that because you have to close that deficit. You can't have a world where everybody just invests in gilts, because if you do that, you'll get no growth, and then the gilts won't be able to pay. The government won't be able to pay the gilts off. You know, you need a strong economy to support the gilts as well. Let's not forget that. We've got the lessons of Europe that is going on there. You know, if you have no growth and a large deficit, we still have one of the largest current deficits going at around 8%. The gilts will not continue to be that well supported.
Yes, I'm just always very worried about the politicisation of pension funds by seeing them as a helpful asset that can be used either for macroeconomic purposes or for social engineering purposes. You know, I just don't think that's the right way of thinking about it. It leads to bad decisions.
I'd agree with that, and I think it'd be fair to say that Mark, and I know how Mark thinks about this, but ourselves, we're definitely not swayed by public opinion. I think there is an evidence-based, intelligent investment process that says we need a risk reduction and we need return. Let's compare and contrast a portfolio of social housing bonds as an alternative to holding gilts and equities as a way to balance that risk-return trade.
It would be a lovely thing if we were in a situation where pension funds only needed to invest in gilts. They don't. We have to deal with the real world of closing those deficits. So we need that extra return, and we have to look at where we get that best risk-return trade-off, and the ability to match the liabilities as well. And you know, these asset classes here that have been mentioned, why they've been held out is because they are particularly good credit quality. Social housing has never defaulted, and you get the ability to help match the liabilities because they have things like the interest rate exposure, and in some cases the inflation exposure.
Merrill Lynch had never gone bust before. But I'm completely surprised. I'm not violently disagreeing with you.
Oh,
as long as we're open-eyed about the risk-return characteristics of any asset class that we're investing in.
I think what you've highlighted for me, Matthew, is that the use of language, and you're right, quite often people oversimplify these and say, oh, they're just a gilt replacement. And I think that's a mistake. And I think what Mark and I have been trying to clarify is it's not that.
And any portfolio, you have a balance of risk. You don't put it all in social housing, even if you get things. You have a range of different risks there, and therefore you have a stronger, more diversified portfolio.
Agree more.
Excellent.
And of course, gilts themselves are no safe asset class, are they? I mean, the UK government has defaulted on gilts in the past. I think was it the war bonds in the First World War.
Well, they've extended the maturity of them. Some purists
technical,
believe it's a default. Some people say no, it wasn't. But
still,
absolutely. Government. There's an interesting concept about what is risk-free. You know, government bonds have defaulted in the past. I mean, you know, the history of Greece is 2/3 of its time it's been in existence. It's been in default, and you know, and it's something we have to think about with gilts as well now.
So. With all this, I mean, have you got, you know, are there asset classes out there that are showing those characteristics, Rob? Are there things out there that you're thinking, well, on a risk-return basis, they are looking a reasonable investment for pension schemes?
So if I take my gilt as my comparator as rates, inflation, credit risk, and liquidity, are there other asset classes that exhibit those, but with different levels of risk on each one of those buckets?
That's on a sort of average basis will come out around the same, even if they're not.
But not even. I mean, so social housing, lending to social housing is an example where I can get some rates, maybe sometimes some inflation, get 150 to 200 basis point pickup, but I'm taking more credit risk and more liquidity risk. Actually, infrastructure debt, either buying secondary debt off banks or actually refinancing debt is an opportunity. There are a whole load of sort of infrastructure investments out there that need debt. They have short-dated bank debt that they'd love to extend and actually borrow for 25 and 30 years, and they'll pay up anywhere between 50 and 100 basis points for a longer-term private placement. Now, actually, compared to the publicly traded bond rather than the gilt, so there is credit risk. Really what you're saying is, am I happy being paid 50 to 100 basis points extra for a liquidity risk? So what you're trading off there is liquidity risk. So infrastructure debt is a great space there. The other one that has been circled around by pension funds and insurance companies, but is sort of hard to get hold of in any size, is ground rents. I mean, ground rents offer a huge level of security in terms of the creditworthiness of the cash flows. The challenge is actually how do you get hold of it in any meaningful size. But there is a whole, I mean, if you think about it, there is an opportunity to step into the world of lending that has been vacated by banks. Now, I'm not suggesting pension funds lend directly, but there are fund managers that have the systems and the expertise that used to exist in the banks. But because of what's happened to spreads, because of the retracement by banks, actually there's an economic return that pension funds can derive on an unlevered basis that is arguably attractive. Debate needs to be had, is that a better risk-adjusted liquidity, complexity-adjusted return than equities? And that is one that needs to be thought through and debated before making that investment. But my view is that we should be exploring all of these options. And my view is that you can construct portfolios that have a better risk-adjusted return. And you know, we have got clients who, as a result of pursuing some of these, one could argue that versus their liabilities have exhibited a better Sharpe ratio than the average UK pension fund. Now, you know, time will tell, you know, to see whether that was the right strategy, but we certainly believe it's worth exploring.
And Matthew, are you sort of, are you looking at, you know, this broad range as well as gilts?
Yeah, very much so. Rob's mentioned some classes, whether you're looking at diversified growth fund, lower risk equities, emerging market credit. There's just a whole range of asset classes that can provide some outperformance. I think the crucial thing is, as well as understanding the risk-return profile, is being clear, can the sponsor covenant stand the risk that's involved? Now, we haven't talked too much about covenants so far, but I think that's an almost an elephant in the room through all of this, because all of this is about when you're taking risk in your asset portfolio, is, you know, whether the sponsor is able to step in if that risk goes the wrong way.
And indeed, that's a very good question. Brings me on to the next point, which is, you know, what impact are these low yields having on the sponsor covenant, and what sort of, you know, what sort of risk can they actually afford to take? I mean, can they afford to take any more risk now yields are so low?
Both funding discussions are very tough at the moment. Pension fund trustees are under a lot of pressure, and quite rightly so, to try and extract what they can out of the corporate pie. Employers are finding it very tough at the moment. Cash is very difficult, and completely agree with Mark's points. They need, and we need them to invest for growth as far as possible. The calls on cash are greater than the amount of cash available. It's very difficult, and I guess one of the movable parts here is timing. It's just taking longer to pay. And whilst taking longer to pay, while getting off the track slightly, but providing more security to trustees in return for that. And that's why we've seen a vast explosion in the number of SPVs and other forms of alternative finance for pension funds. And I think that's, whilst it's not strictly on our subject, I think that's a really important way to bridge this gap between the impact of low yields and what that's doing to liabilities, and the difficulties that UK PLC has in meeting funding demands.
Thank you very much. David, we've been talking a lot about the impact low gilt yields are having on pension scheme funding, but have they had the same effect on insurers? We don't seem to hear insurers sort of talking about this in the same way.
Well, I think the effect has been sort of limited and second order. I mean, the reason for that is that in the insurance regulatory regime, it really does not make sense to take interest rate exposure, which means you try and immunise your business against movement in short, long and medium-term interest rates. Therefore, gilt yields moving up and down really doesn't have a huge amount of impact on our balance sheet. I mean, thinking about, you know, August, September 2011, you know, our liabilities moving up and down by hundreds of millions of pounds, but our net position was really only moving by single-digit millions. And that's because we were pretty much fully hedged against interest rate movements, therefore fully protected against gilt yields moving up and down. So yes, there's some impact, but it's not significant because we don't take the interest rate risk. Now, it has affected our business in the sense that our potential customers have less money because our insurance pricing, how we price a buyout, reflects low gilt yields, and that means the pension fund needs to give us more money in order to ensure the benefits. So to the extent pension funds aren't matched, low gilt yields would in theory reduce in lower demand. We haven't seen that because people have actually changed the sort of insurance transaction they're looking at. They're currently looking at using the gilts they do own to buy insurance.
Very much. We're sort of running out of time for this debate and coming to the end. But one thing I'd like to ask each of you before we end the discussion is what are the key things that sponsors and schemes should be thinking about over the coming months with regards to their gilts and with regards to what we've been speaking about today? And David, could you...
I would say a key thing to think about is, can I use the investment that I have in gilt more effectively and efficiently? You know, one of the things you could consider would be using the gilts to buy insurance or using the gilts to buy other forms of long-term investment where you can effectively get a yield pickup, but only do so if you really understand, you know, the investment you're making.
Would you agree with that, Rob?
Yeah, I mean, and again, so I suppose repackaging it into two takeaway points. I think one is be productively paranoid. So what if rates stay low or we go into a Japan situation? And I think the second point is have a risk-based framework. And I think within that risk-based framework, what David said either makes sense or doesn't make sense for you. And more thought and emphasis needs to be put into thinking about what your risk appetite is.
Those points should...
I think points I'd wholeheartedly agree with. You know, can you afford as a pension scheme, with a discussion with your sponsor, you know, if yields do go lower? That is really quite possible still. We have that Japan scenario. And are there other better things you can do with your gilts? I mean, David's mentioned some insurance contracts, but can you get involved in some of the asset classes that still act as a hedge, but do give you an incremental return that you're happy with that risk-adjusted return? And the infrastructure asset classes, the social housing, those are great places to be as well.
Last but not least, Matthew.
I think for those pension funds that have de-risking journey plans in place, have another look at your triggers, whether they be yield-based triggers, funding triggers or time-based triggers. Just check whether they still make sense in the current environment. And for those schemes that don't have a journey plan in place, well, you might think this is a very bad place to start from, but nevertheless, if you put together a whole package of solutions, some of which we've mentioned today, and there are a host of other risk management solutions and strategies that can be used, then if that's you can actually make progress over a period of time, and you certainly won't do that if you don't have a plan.
Matthew, thank you very much. I'm afraid that's all we have time for in this debate. All that remains for me to do is thank our panellists, Matthew, Mark, Rob and David, for all their time, and to thank you, our audience, for listening. Thank you.